Today's topic is, I love my advisor. I love my advisor. Their staff is so wonderful. Well, I want to say this. I hope people say that about us. I hope they say that about me. And I believe that a lot of people, if not most, I hope all 100% of our clients are saying that. But a big but in however is your advisor. And this, of course, is if you're listening and you're not working with us, because I do know some of our clients do listen in. But we don't want you to just love us and love the staff, etc. We want you to be comfortable and totally confident about the investment approach and the investment strategy. I'm going to tell a success story, if I may say. I call it a success story, and it's a story that I want to give somebody a compliment of. So we did a successful retirement investing presentation. Actually, I did it. I say we did it because the staff is there, etc. And I said and I did something that I do a lot. And it goes a little bit like this. I say to the audience, and I say this to you, and it's a sentiment that I think many people carry around. And it goes like this. I love him. I love her. I've known him forever. And I've just covered that a little bit. So the compliment is this. There was a gentleman that came to one of our recent seminars here, and he came in and I asked him what motivated him to come in to have a complimentary review and analysis of his portfolio. And he told me a couple things. First thing was he didn't think that his advisor was that savvy or that geared up for really helping him for his retirement. He's a few years out from retiring. And he said the other thing is when you mentioned and you said that whole thing of I love him and I have been with him for so long, therefore I just have to stay, something went on in his mind, which was a revelation that he was really stuck with this gentleman that he was working with, who he knew for literally over 25 years. But he knew in his heart of hearts that something wasn't right with respect to the transitioning pre-retirement. And some of you listening in, you are already retired, and your transition to doing what's good and right, which is effectively making sure you are in the distribution phase strategy of investing as opposed to the accumulation phase strategy of investing. And that's usually what I talk about when I'm talking to people or when I'm talking in my seminars and workshops, because many people get stuck in the accumulation phase strategy all the way into and through their retirement years because somebody calls themselves a retirement specialist when they have clients that are 20 years old, 30 years old, 40 years old, 50 years old, 60 years old, 70 years old. And the reality is they really do not truly specialize as a true professional fiduciary investment retirement specialist. I'm going to talk about that this morning. So this gentleman, I was quite impressed that he had a revelation. One of my big concerns when I talk to people generally is they don't have the revelation that this gentleman had, which is he realized that his biggest thing, or one of the biggest things that had him still working with this advisor, was he's a nice guy. The investor, our new client, had been working with the advisor that he had been working with for 25 years. And I understand it's not easy for people to make a change, and I want to say that. But I commend him. I said, I want to compliment somebody, and I'm complimenting this gentleman in the Baton Rouge area on taking the bull by the horn. Why is this radio show called Your Money, Your Retirement, Your Life? It's because it is your money, it is your retirement, and it is your life, and you need to and you want to get it right for you. So one of the biggest things that I see is a problem for people when they are trying to do their retirement investing is they get stuck. They get used to what they're doing. They get used to who they're working with, and they simply don't understand how fundamentally different it is when you are in retirement, when you don't have earned income in retirement and you're not saving and you don't have a match and there is no dollar cost averaging going on buying low shares because you're not adding money. You're about to take money out. These things are so incredibly fundamental that it's amazing to me that there isn't a basic understanding. And so as really simple as this concept is, it needs to be more than a successful path of making good decisions and doing the right things where you are truly investing in a distribution phase strategy approach that's going to work. Because if you are stuck in an accumulation phase strategy of investing, which is cookie cutter mutual funds typically, maybe some exchange traded funds, limited choices, maybe they give you some different investment company choices, whether it's T. Rowe Price, Vanguard, etc., whatever it might be within your selection of funds. Maybe there's some Fidelity funds in there. Let me say clearly, these are very cookie cutter types of investments. Why are they such cookie cutter types of investments? Well, let's start with the facts. The facts are that 80 to 90% of mutual funds in various 20-year studies of what the results are with mutual funds, the performance of 80 to 90% of funds, mutual funds, underperform the Standard & Poor's 500 index. So some of you may be thinking right now, you may be thinking, well, Drew, I've done pretty well. Well, I would say this, I can understand why you could get away with maybe doing okay with all your savings, with your discipline. And that's what I find in our clients that we work with have had significant, huge, great discipline of saving, whether it was just you, the individual, you and your spouse, however that is. And that's a huge thing in terms of success in savings is the discipline. But the things that cover up the inadequacies of mutual funds, when you are saving money in your accumulation phase of your life, is you get a tax deduction. You have certainly tax-deferred growth, which you're going to have in both phases of your life if you roll your money over properly and you keep your 401k or qualified monies, any 457B, 403B plans, you roll it over to an IRA. You can still keep the tax-deferred growth. But the key things that cover up the inadequacies are the fact that you get a tax deduction on pre-tax savings, assuming it's not the Roth portion of your retirement plan. In addition, many of you are getting a match. The other thing is back to discipline. When you have the discipline and you're set up on an automatic payroll deduction and you keep saving money and the markets go down and you buy more shares, well, that works over time. When you have time, when you have maybe 10, 15, 20 years out. But when you are certainly 5 to 7 years out from retirement, 3 to 5 years out from retirement, and I would say even 10 years out, you should start looking at the manner in which you are investing, that it should start to look more like the distribution phase. It is a phase in kind of an approach, but certainly if you are retired or you are very close to retirement, you want to be in a methodology of investing that's going to be what I hear from 99% of the people I work with. They are thinking of the triple advantage or the quadruple advantage. The triple advantage is preservation, maintain your money, keep at least the money you start with, get growth, moderate growth without high risk as number 2. Number 3, be able to get income that you can live on, income from income. And the fourth factor, if you want to call it the quadruple advantage, as opposed to that triple advantage I just gave you, which again, what is that? Have preservation, growth, and income. The fourth component for many people is they want to have a legacy. They want to create a legacy. They want to create an inheritance for their family. I certainly know many people think, oh, my kids are good. They don't need any money. I'm going to spend all my money, which is a danger point right there also when you think you can spend down all your money. He had a revelation that he realized just because he's working with somebody who's a nice guy, who apparently gave him good service, he realized that this investment advisor had him in virtually all stocks. It was in the minimum of 80% in stocks. The gentleman is going to retire very soon in the next couple of years. He's at significant risk. And when I ask him what kind of investor he is, he tells me he is moderately conservative and that he does not have much risk tolerance for losing that much money. But that objective was not in alignment with what his investment strategy was and how he was positioned. And so he made a very bold decision, which is to do something that's not easy. It's not easy to tell somebody you know and you like you need to move on. And why did he move on? Because he knows we are about the triple advantage, the quadruple advantage, and he knows we have the goods, the means to do it. We have the professional money management team to get 5, 6, and even 7% in yields on a regular basis. So what am I talking about today? I am talking about I love my advisor and the problem of getting caught up in that sentiment of I love my advisor when things are not right. You are listening to Your Money, Your Retirement, Your Life. I'm your host, Drew Pelton. It is your money. It is your retirement. It is your life. That is the sentiment I am confident you agree with, and I believe you realize you have to have that sentiment strongly embedded in your heart and mind in order to make good and great decisions for you. And the same gentleman that I complimented in the first segment about how he got beyond, I love my advisor, but I need to make what's good and great decisions for me, he asked me a good question. Drew, since you're so young, I feel young, like, most of us, no matter how old we get, we still have the 20-something-year-old in us. I'm happy to address it each and every show, but the fact is I'm not going anywhere. My life is better helping people. I love what I do. I'll just call it subcontractors. Contractors and subcontractors are not that easy to deal with and work with. Plus, just generally, there's a lot more to it. So we have made great progress, and I have the best guys now ever, I believe. I have a good interior designer, strategist, in great coordination with my general contractor who's doing a fantastic job. Drew Pelton's not going anywhere, and his team is not going anywhere, and we got the new building so we could grow. We'll have double the space at first. And I have a renter in there. I've had a renter in there since I bought the building. So they're in 1/3 the space. They have about 2 more years to go. We'll see if I'm going to renew the lease or not. My thoughts are right now I'm not. So that'll give us triple the space for what we are doing here. The building, by the way, is on Jefferson Highway. So it's about 0.7 of a mile from where we are right now on Bluebonnet. But the date is this. May 1st is the projected date. I would think truly would be June 1st, 2026. So we've only got a few more months to go because we are doing it good and right and nice so that it is a beautiful place for the staff to work. It's a beautiful place to attract the right staff, and it's a beautiful place for those considering working with us and those that are clients to come on a regular basis for the next 20 years, 30 years, because the staff is all teed up for the future. Warren Buffett just retired. I don't know exactly what age it was, but it was 90 something. When you love what you do, you love what you do, and you want to keep doing it. And that's who you're listening to right here. So you will continue to hear this radio show, and you will continue to see and hear Drew Pelton, Retirement Solutions, all about the dedicated group that is helping pre-retirees, those planning for retirement, and those in retirement to have a good, safe, secure retirement, understanding it's your money, it's your retirement, your life. Well, before I jump in here about this whole sentiment here about I love my advisor and how that might get you in trouble, I'll cover that a little bit, but I want to drill down a little deep here on a couple of other things. But the bottom line is this. I gave a compliment to a gentleman that finally realized that when I said in my seminar that some of you do this, oh, I love him, I love her, and something resonated with him where he realized that he was caught up with his advisor just because he had a relationship with him. The guy was a good guy. You know, most advisors are good people. Why would you stay with somebody if they weren't a nice, good person? I mean, you know, that's fundamental. And that's somewhat of the allure that gets people trapped. But the key thing is what's happening is too many people are doing the almost emotional, if I may call it, the emotional, the qualitative thing of I like him, I like them, they must be okay. And there's not enough clinical discernment, and there's not enough math assessment, and there's not enough of let math be your guide and wisdom in making your decisions. Because when you are caught up just in the lovey-dovey, I love him, I like him, I've been with him, and, you know, in this case, him could be a her. And the question is your guy or gal a financial advisor, or are they a product salesman? And that's going to lead into what needs to be turned right side up. But the whole point of it is don't let previous relationships get in the way of what's good and right for you. Maybe what worked along the way, and along the way right now in a short-term thought process is in the last 17 years, since March of 2009, we have been in a secular bull market. Now, 17 years is 1 year short of the longest secular bull market in American history. The longest secular bull market in American history was between 1982 and the year 2000. And of course, along the way, you get ups and downs. But this long-term growth effect and this long-term growth markets are going up. The longest secular bull market in American history was from 1982 to the year 2000, which was the year when the tech bubble burst and the markets went down 50%. And that 18-year longest run was since 1792. 1792 is deemed to be the beginning of the stock market. If you've ever been to Wall Street, which I have, and I've rung the bell there with some associated groups that I'm part of, I got a coin. They give out a little coin to people that are guests, and the coin says 1792, reflecting that that's how long the stock market's been in existence. Well, since 1792, the longest secular bull run was from 1982 to 2000. But the reality is that if we are now 17 years since the bottom of the housing crisis, the Great Recession, the financial crisis, which started at the end of 2007 into 2009, and now we've been in this primarily up market, even in consideration of the COVID-19 2020 drop, that we've been in an up market for 17 years. But where are we and where are you, and how much risk can you take right now if you are right before retiring or you're in retirement? And what's going to happen next? A question for you is this. Does history have a tendency to repeat itself? Do you think so? Do you think that history has a tendency to repeat itself? And if your answer is yes. And if that is true, and I'm only saying that, if I personally believe it, and it's shown that market history, stock market history, has had a tendency to repeat itself. And if you think about all I'm saying right now, comparatively, longest secular bull run, 1982 to 2000, compared to now, since the bottom of the market, March 2009, it really didn't take off until really 2013. But bottom line is, since March 2009, we pretty much would be considered to be in a secular, long-term bull market, up market. The question is, if history has a tendency to repeat itself, what gives and when does it give? And are you, the retiree investor or the pre-retiree investor, truly invested for success? Are you invested, and are you going to continue to be invested in an accumulation phase strategy of investing, which is taking on more risk? Or do you need to be more in a defensive position, as in a position that is going to assure that you are not going to have a serious decline and you're not going to go down with the ship, meaning you're not going to go down in a 50% correction, a correction, crash, decline, all the same. Correction sounds better, right? That's what the voice of Wall Street is. It's a correction. It's not a crash. It's a correction. Well, hey, it's all of that. It's a correction. It's correcting because it's too high. It's a decline, and a serious one at 50%, obviously. And it doesn't work for retirees, particularly when on top of it, you don't have high yields, which are high dividends, high interest in the range of 5 to 7%. You can only get that from professional money management. Yes, I did say it 3 times. The record is not broken here. Okay. You need to understand the power of investing for income. I hope you're getting some great insights. And in addition, if you would like a complimentary review and analysis of what you're doing to see if you might be stuck in the accumulation phase strategy of investing, where you should be, need to be for your best protection in the distribution phase strategy of investing, give us a call on the same line, 225-831-1394, and I'm happy to talk to you personally. We'll set up a time. You can talk to any one of the staff to set up an appointment when you call in. I love my advisor. Well, it's the problem of the sentiment of I love my advisor when there isn't true substance and true clinical mathematical soundness in the investment approach. That's what I'm talking about today. And I'm going to talk about how you have to flip your paradigm, how you have to flip it upside down in your thinking to truly get it right. I've been talking about in the last couple segments about how people get too much in love with their advisor, and they don't even realize that their advisor is a product salesman and their advisor is a cookie cutter salesman. And the cover up is, you know them, you like them, they're a nice person, they seem like they're with a good firm, you're doing okay because the markets are up 16, 17 years, everything seems to be going good, maybe you will. I'm not commenting on that, I'm just making a point. The point is how you think about things, and is your thinking in alignment with what's best and right for you and your family and your future, and is the person you're working with truly not just capable, but do they truly have the right advisory strategies and knowledge and experience and expertise, or not truly have it? And do they have everything, or are they doing cookie cutter, be in the market, do these mutual funds, they have big names, good names, and you think you're doing okay, and you haven't had to think about things because markets are going up for 17 years since 2009, like I was talking about last segment. Where are you? So hugely on this show, I am pushing, pressing, pulling, persuading for what? For you to take ownership, true ownership of your own monies, your own retirement, your own life. It's your money, it's your retirement, your life. That's why the name of the show. I categorically think this biggest hang up people have is they don't embrace what I'm saying. They don't embrace, it's my money, it's my retirement, it's my life, I've got to get it right. And their advisors truly not only not embracing it, they may talk like they are, but many are not positioned by way of expertise and knowledge on the, call it the qualitative side, and on the quantitative side in terms of having truly all investments and the ability to generate high yields at 5 to 7%. I have to tell you, as God is my witness, no one, and I've been doing this for 140 years. You know, I'm being a little silly here now, but I have been doing this for 40 years. I mean, the fact is I have never seen one firm, I don't care who it is, Morgan Stanley, Merrill Lynch, Ken Fisher, LPL, Vanguard, Voya, on and on, T. Rowe Price. I mean, the world is caught up in this growth phase, this go for it, go for it. It's Wall Street cheerleader talk. You got to take big risks to make big returns. Well, you might get away with that in the accumulation phase, but you might get slaughtered literally in financial markets when you are in retirement and you're not adding any money and you can't do dollar cost averaging. That could be a big hang up if you're going with that play right now. Look, you should know, I want everybody to make as much money, but if you don't make the kind of money you want to make in your retirement savings smartly, wisely, and in a defensive way where you are positioned to have a floor where you're not going to get slaughtered by the next downturn in the market, you could get devastated. It doesn't take but one major crash of 50% and you being in the accumulation phase strategy of investing, and you have major losses, you're taking money out, and you don't have high yields, and so you're invading principals, selling shares, and you're cooked in 3 years. And we are, at some point, I mean, I can't imagine whoever you are, whether you're not sophisticated, you have a little knowledge, you are sophisticated with respect to investing. I mean, anybody just thinking about this, at some point, something's going to give here. When's it going to give? Am I suggesting it's going to give this year in 2026? I'm not. I don't know. But when it gives, it gives. And if you look at market history, if you look at the way markets go, if you really think about how inflated AI is, right? Artificial intelligence. If you look at the moving parts that are going on in the world, Iran, Israel, America, the Middle East, etc. Okay, how does that affect things? Could it be a good thing? Well, maybe it could be. Could we be doing better with oil stocks and defense weapon kinds of sectors? Sure. But do you really know that? I mean, generally, if you just simply stick to the basics of history, what's going to give and when, and are you solidly in place or not? I mean, the gentleman that I was complimenting who basically said, I'm not going to get caught up in this. I know my guy for 25 years and, you know, I think I love him. And he didn't even realize how much at risk he was. And he didn't really realize the discrepancy of his answers, which is he said he's moderately conservative and he didn't want to lose that much money if markets went down. Well, he was at literally over 80% at risk in the stock market in his portfolio. And his objectives, his goals, his desires, his needs, his wanting to take care of his family, the desire to have a legacy, all of that was not in alignment with the level of risk he was taking, considering that he was just 2 or 3 years out from retirement. And for those of you who are already in retirement and you don't even have any earned income and you're relying strictly on your assets, and you know, maybe not because you could have a pension and or Social Security, I understand, but when you are significantly relying on your assets to be there, whether you need the money or not, remember, qualified money, you have to take required minimum distribution. So that's one reason why it's the distribution phase for sure. And then here's another big thing. Inflation. We tend to have to invade or get to our assets in addition to pensions and or Social Security. And then the big thing is this. The biggest cost that retirees have in retirement is what? the cost of long-term care, whether it's in-home care, assisted living, or in a long-term care facility. It is the biggest cost that retirees have, and it can deplete assets very quickly when there is a demand on healthcare issues or long-term care cost. So all of this considered, you want to, as a retiree, be in a solid position, in a position where you have some defensive positions built in, and part of that is and can be led from investing from income, high yields, high dividends, high interest. So when you look at your statement and it says yields, you want to understand this. This same gentleman I was complimenting, and it's very interesting how many times on line items you'll see various percentage yields. And I remember on this gentleman's statements, I would see less than 1%, less than 1%, less than 2%. One was 3%. And then they don't give the average. They don't want to give the average. It was in all his various accounts, IRAs and Roth IRAs for both him and his wife, it averaged 2%. And I had told him in the seminar, I said, that's what you typically see, typically 1 to 2% at maximum for dividends and interest. Well, when you need to take out 4 or 5%, let the math be your guide and wisdom. Well, you're off 2, 3%. That's huge on an ongoing basis. That's huge in terms of how much money you can get out of your investments. So this is so typical that I see these low yields, and I call 2% low. And so many people are under 1 or 2%. And many of you don't understand like how the math works. What I did was, and some of you that are good with math and most people aren't and don't like it, is basically it did show the annual income that was projected to come out of the investments. And all I did was take that number, divide it into the account value. Now, that could be a moving part in and of itself, but it gives you an indication. In every single one of the accounts that he had, it was either 2% or just under 2%. But it wasn't revealed on the statement. I had to do the math for the gentleman to get him and understand him to say it. I mean, he wasn't like he was struggling. He wanted to see it, and I just walked him through it. And so he's having more revelations about understanding what he didn't have. And then I demonstrated to him sample portfolios that show how our asset classes, and there's various different asset classes beyond just stocks. And normally it's individual securities that drive higher yields. And you need the right skill set, the right professional money management leader team in order to do that. And it's truly proactive money management. It is about high yields. It's about high income. You either believe me or don't. I can tell you, as God is my witness, and I don't say God lightly. Okay, I have never seen anybody come in my office and it matched what we were doing in terms of the high yields. Never. I have seen thousands and thousands of statements as many years as I've been doing this. And so I majorly am trying to motivate you to understand what you need to understand. Income first. That'll give you ultimately some growth. If you don't need to take all the income, then that's going to be reinvested. But also that income gives you typically bigger companies that have lesser volatility. So that's huge. Now, let me say, I keep talking about flipping this thing upside down, and I'm going to cover it. But the bottom line is that this is what I find when people come in the office. I can tell by what they tell me. I can see by what's on their statements. What happens is you go into an advisor's office and yes, they know a little bit about you, but the discussions go pretty quickly into you should be in this allocation and we're going to have you in 80% in stocks and 15% in bonds and little cash and some alternative investments. And that all adds up to be 100%. They've got you majorly at risk. Maybe it's not 80%. Maybe it's still 70%, but it's not only typically high risk, it's very cookie cutter mutual funds. And more so with my point of what I'm trying to say this morning is that it's an approach of allocation and its product and its investment first. And then, oh, by the way, this should do this for you, without really disclosing how much at risk you are and how much danger you could be in if the markets crash. Okay, that is what I see 99% of the time. Let me tell you how to flip it upside down. Let me tell you what we do. Typically, on a first meeting, I'm 45 minutes to an hour talking about the person. I'm getting all their facts. I'm getting all the factual information about their family. Have you done estate planning? What's your income? We have a very thorough fact finder we do. We don't just get it. We talk about it. And that's just the beginning. I'm not talking about allocations and investments. I don't really need to at that point. Why? As a true fiduciary and a true independent, we have everything. Since we have everything to offer, I'm not going to talk about offering things when I don't know I need to know who the investor is, what's going on, what drives you, what motivates you, what's your situation. I mean, what are all the dynamics? It's got to be planning. It's got to be strategy. It's got to be fact-finding and knowledge about the situation and the person and the family first. And then it's too easy if you truly, as we do, have all the investments that are available, whether it is investments that are assets under management, whether it's various categories, stocks, bonds, bond-like instruments, or whether it's guaranteed types of programs from CDs to treasuries. And some people do like annuities, and they have to be the right annuities. I mean, we don't need to get to the investments until we truly know who you are. And so the flipping upside down is planning strategy first and full understanding of the client and their needs and their situation, including income needs, and then the investments that truly match the goals, the objectives, the needs, the desires, the situation. And if you think you're not in the right place, and I can tell you just from my perspective, there's a 99% chance that you are not. And how do I know that? Because in my thousands of statements that I've seen and the thousands of meetings that I've had, I've never heard and seen somebody matching what we're doing. Now, I know some of you are going, Drew, you sound pretty confident. Well, I am. Okay. All right. So please accept my enthusiasm and my confidence. And if you need a checkup, I recommend you give us a call on 225-831-1394. That's 225-831-1394. Here's the bottom line. Don't love your current advisor, who may be more product salesman than an advisor, not with all the tax knowledge and estate planning knowledge and expertise that they should have, who you just happen to know and you like them because they're a nice guy. Don't let that get in the way of doing what's good and right for you, because it is your money, your retirement, and your life. That's why the name of this show. All right, it's been a pleasure being with you today. I am passionate and fired up about the truth, the whole truth, nothing but the truth, and what works, and how to win and how to be successful in retirement investing. And don't accept cookie cutter, generic comments and or investing. All right. You want to be with me every week at the same time for this full hour. It will help you. I assure you. Be back with me next week. Thank you. Be blessed.